In a Truth Social post today, Trump says that Fed's Powell must lower interest rates. And this time, again, Trump called Powell too late Powell. And all of this came out this morning after we got the ADP non-farm payroll number, which came in much lower than expected at 37,000 jobs created compared to the forecasted 111,000. And this follows the previous number that was also much lower than expected. So we're seeing a little bit of softness in the labor data this morning. Of course, Trump is accusing Powell of being too late because these numbers are coming in soft, and he's suggesting that the Fed should be cutting interest rates by now. But let's unpack that and take a look at some trade setups that we could take advantage of in all of this craziness. So an easy one in today's market in terms of a reaction to this was gold spiked higher off of all of this uncertainty, specifically following what happened at 10 a.m. Eastern time. For the first time in almost a year, we got services PMI numbers, which are a forward-looking indicator of the economy, suggesting that there could be some contraction ahead. For the first time in a while, we see a reading of 49.5, a sub 50 reading suggesting contraction, compared to the forecasted 52. That was a big miss, and it caused the market to react. You can see at 10 a.m. Eastern when that number came out, the gold market shot right away to the upside as people are a little bit more concerned about the economy following these two weaker than expected data points today. Gold does seem to be narrowing in on its previous all-time high, right around 34.40 to 34.80. We did get this spike intraday, but in terms of a closing high, we are not that far off. So should we be buying gold and looking for fresh all-time highs from here? How likely is that? Well, with today's services PMIs coming in lower than expected, as well as the manufacturing numbers earlier this week coming in lower than expected, and the ADP numbers coming in very soft, it is looking more likely like the dollar could remain weak, which could give us an overall bullish environment for gold. However, the big one still comes on Friday. We get the NFP report as well as the unemployment rate statistics out of the United States, and those will be a huge decider of whether or not this economic heat map confidently goes bearish or not, specifically for the US dollar. The dollar index does look very bearish. When we look at the daily chart, take a look at some of the longer term momentum here to the downside that we are seeing. Put your moving averages on, put your filters, even just using simple price action. It's very obvious to tell that we are in a strong downward trend on the daily chart. And if the NFP report comes in really soft, I would not be surprised if we actually do take out these previous lows and continue the downward trend that we've been on for some time. You can see today, stocks are mostly mixed. When we take a look at the S&P 500, really not too big of a move in either direction. While there was an initial move lower on some of this data this morning, especially around the 8:15 ADP employment numbers, you can see we've bounced back pretty nicely since that 10 a.m. drop-off due to services PMI, showing the resiliency and willingness of investors to still be buying stocks aggressively in the face of some weakening economic data. But remember, guys, that this weakness in economic data does do something to the Federal Reserve's calculus. Specifically, the probabilities that the Fed cuts interest rates, which is a stimulant to the US stock market and a bearish catalyst for the dollar, is looking a little bit more likely in the July meeting. Now, June is still very unlikely to see rate cuts, but the July meeting is now much more potentially viable for our first rate cut, with a 30%, let's call it, or a 30 to 70 split on probabilities for the first rate cut taking place in July. Then when we look out to September, there is only a 23 or so % chance, according to the bond market, that there will not be a rate cut all the way out to September. So by September, we are base casing saying that there is likely going to be a rate cut. Now, the Fed is also waiting to cut rates as much as they can, simply because tariffs are a big unknown in their calculus. What I mean by that is when we take a look at all this economic data and we say, okay, yeah, it looks like it's weakening, maybe a rate cut is in order. They're looking at that and saying, yes, but then we also have tariffs and we don't know what to do with that. Well, we do get some deadlines coming up, and when we take a look specifically at the July 9th, this is a big one, right? That's the end of the pause for the European Union. So basically in June, we really need to start seeing some deals. Otherwise, the Fed is going to be in a really tough situation where they either have to cut interest rates and hope that tariffs work themselves out, or they get into a better situation where tariffs become more clear. They know what they're working with. They know how much they could potentially expect and I say that very specifically, how much potential inflation could come out of the tariffs. and then they can make a more informed decision. Right now, the Fed is operating in the blind in terms of what's going to happen with these tariffs and how inflationary could they actually be. And I'm currently still in my Russell trade that I've been talking about recently on the channel. I picked it up a little bit ago here, still in the trade, and I'm watching to see if we can break out through some of these daily chart levels of resistance. We can see around 2100. We are sitting there as we speak. And let's see if we can actually get a breakout. Putting in another higher high would be very confident for this trade idea, as would be for the other indices as well. You can see the S&P 500 trying to break through these highs, NASDAQ also confidently already breaking these highs, and the Dow Jones is also testing this area. I think that this is a major level of resistance for the indices at this time, and if this can break out, we could actually be seeing the next wave higher back to those fresh all-time highs. But how can I be confident in being bullish on the indices right now when there is so much uncertainty around tariffs? Well, in today's live stream, I had a long rant about what you can and cannot control, and what Powell says next or what Trump says next. We can't predict that sort of thing. However, we can look at economic data, price action, and these things, given barring everything else, can actually give us some really decent ideas of where the path of least resistance for markets may be headed next. It never guarantees what's going to happen next when I do a breakdown on a chart, but what I do is I look for the simple, most likely scenario based on the general macroeconomic data points, the sentiment analysis of the market. When everybody's on one side, I'm looking to be on the other, and of course, simple technical analysis like trend following momentum, as well as seasonality of specific markets and when they tend to do better or worse during different parts of the year. So on a high level, I'm still getting some strong readings on the NASDAQ, for the Dow Jones, for the S&P, and the Russell, right? So I'm getting these trade ideas from the Edge Finder. These bullish setups are looking at all these different economic metrics and saying, generally speaking, these things look more positive than negative at this time. Taking a look at the put to call ratio on the S&P 500, you can see that investors are back to, and taking a look at the S&P 500's put to call ratio, you can see we are back in the extreme fear level, just signaling that way more investors are buying puts than buying calls in terms of the volume ratio between how many calls, which are bullish bets, versus how many puts, bearish bets, are actively trading on the market. And so when we see this, this has been historically a pretty good indicator for timing, not necessarily to a dot or a perfect time or a price, but a general idea of when this gets overextended, that to me is more of a contrarian bullish signal. And when it gets the other way, like if we take a look at like May 14th, right? Those are times where you're getting a little bit more euphoria, and I may want to scale out of positions, take profits, trail a stop, etc. It's one of my favorite indicators. I use it all the time, the put to call ratio. We also have it for other assets, like for example, gold, which has recently seen a big interest in put demand as well, hovering really close to that high put demand threshold that we have. And we can look at all sorts of different assets within the Edge Finder. For the Forex traders out there, I took a trade yesterday on the Euro British Pound. I went short on this one. Analysis behind this one is basically soft inflation out of Europe and hot inflation out of the UK has led the economic heat maps, which I'll show you in a second, to lean opposite in these two currencies. Weak for the European Union and strong for the UK. Momentum also on this chart seems to be headed lower, so I like the setup here. And I took an initial small short position with willingness to add if we get a higher price movement. You can see here is the screenshots that I captured showcasing what I was discussing about the European economic heat map suggesting weakness for the euro versus the British pound getting quite a few positive or bullish signals within the Edge Finder's economic heat maps. Every trade that I take inside of our VIP group comes with a full breakdown and analysis behind why the trade was taken. And if you're not already in the VIP group, it's a great time to consider joining. Considering that we're doing our biggest sale discount of the entire year, we're offering 40% off to join our VIP group using the link and promo code in the description down below. However, if you stuck through my little advertisement here and you're interested in joining our community, we'd love to have you there. It is an education first group where we actually share insights, signals with entries, exits, analysis, everything in between. We have an open chat room, we do coaching webinars, and much, much more. And if you stuck through my ad, then I want to let you know about how you can get actually 45% off. You get an extra 5% off if you send us a direct message using the first link in the description down below. We do this so that you can connect with someone on my staff who can make sure that you're a good fit for the VIP group and see if it's right for you. So if you have any questions about the VIP service, click the first link in the description down below. So taking a look at the Forex side, we can also see that the dollar is back down towards its lows as a reaction to everything that we just got done discussing on the economic data front. ADP numbers and services PMI numbers hammered this thing back lower after having a nice spike up yesterday. We do see some weakness still forming for the US dollar, and we're at a pretty decisive point for the DXY. If the dollar index breaks this level, like I said on the NFP report on Friday, for example, that could be a next leg lower to this downtrend that we've seen already in 2025. Of course, benefiting from this would be currency pairs like the euro against the dollar, which I am not very bullish on, considering the euro also doesn't look super attractive to me. But when we look at the British pound, you can see it in the price action here. The fundamentals really favor the British pound over the US dollar at this time, in my own view here, based on the economic reports that I've just got done discussing with the UK economic heat map and the US one. I'm a buyer of this currency pair on pullbacks. The dollar yen is back down towards its lows as well. This one remains very range bound. The dollar Swiss franc looks much like the DXY, back down towards its lows. And here's dollar CAD, which continues to look very weak. The Canadian dollar looking relatively strong against the US dollar at this time. Not a big fan of this currency pair at this time, though. Really don't have a strong, decisive view on this one. I'm taking a look at the top setups page specifically for major currency pairs, and I'm actually really impressed with the pound dollar. It's getting a very bullish reading, which is a +9 score. And the euro is also getting a +7 score. So while I probably won't take the euro trade, I'd rather take the pound trade if I can get a pullback on that one. It is interesting just to note we're seeing a little bit of dollar weakness here on the Edge Finder. However, still several currency pairs getting a neutral reading against the US dollar at this time. Here's a look at the Australian dollar. Very, very choppy. This one has been back and forth the last few days. However, you are sitting right now at a pretty significant potential breakout point. Maybe we do see some upside on these currency pairs if you get a weak NFP report on Friday. Same thing for the Kiwi dollar, trading just above this level of resistance. We'll see if this actually now becomes a level of support here for the bulls, as it looks like it's trying to be. And today's video is sponsored by DNA Funded. If you've not heard of them before and you are looking to get funded this year, they offer 1 and 2 phase challenges. They offer profit sharing up to 90%. And with our promo code A1T20, you can get 20% off any of their challenges. So check them out. And if you feel you are ready and up to the challenge to become funded this year, check out DNA Funded. Like I said, the link and promo code can be found in the description down below. On today's Market Insights podcast, I spoke with Johnny Hart about whether or not all of this bad economic data that we saw today could really seriously impact the Fed's next decision, and whether or not Trump will have any sort of impact on Powell's decision-making process. Check out this clip, and if you'd like to see the full podcast or listen to the full podcast, I'll leave a full link in the description down below. I encourage you, actually, if you do not already follow along with the podcast, if you're somebody who likes to listen to stuff while you drive on fundamental analysis, it might be a good fit for you. So add it to your playlists, to your podcasts, wherever you listen.
The ADP numbers, of course, reflect on jobs, and we've already had reaction from President Trump after these numbers have come out. He's called on the US Fed Chairman Jerome Powell to lower interest rates after what is actually quite weak jobs data. Interesting to hear that response from Donald Trump, but the question is it going to make any difference in terms of the rates?
Yeah, no, I mean, to your point, Johnny, pretty quickly after this data point came out, Trump says Fed's Powell must lower interest rates, according to his Truth Social post. And we do see it in the 10-year. We're going to get to that in just a moment. But with the numbers that you mentioned, so let's just go through them really quick. The ADP non-farm employment change numbers forecasted for 111,000. They came in at 37,000. That's a pretty steep miss in terms of employment change. In terms of revisions, there was very little revision, slightly lower from 62,000 previously to 60. So the big thing here, the big story for the labor data is still kind of unfolding this week, because we have the NFP report on Friday, we have the unemployment claims tomorrow, and we have unemployment rate as well on Friday. We also had JOLTS job openings to throw that into the mix, which was a report from yesterday, which did come in upbeat. So we actually had a strong job openings report number followed by a weak ADP number. So I think it's a little bit, we still need to wait and see, I think, from going into the end of this week, how the rest of that data falls, because right now I'd say you've got one in each hand, right? One for the Hawks, one for the Doves in terms of rate cuts, rate pauses. The story here with ADP numbers, though, with Trump reacting to this is, he didn't say anything yesterday when job openings were strong, but has said something when ADP numbers have come in a bit soft. The big question with all this is whether or not tariffs give us any sort of confidence, because if there's any development, any knowns that come out, then I do think that it is appropriate. We've talked about this with Kenny when he's been on when we discussed this topic. I do think it's appropriate for the Fed to begin cutting interest rates. But the big question mark for the Fed is where's the inflation yardstick going, if you will, if you get these big sweeping tariffs back on the menu and suddenly trade dynamics do cause some sort of sticky inflation scenario again, right? So the Fed is caught between a rock and a hard place, as it seems they always are. But again, these ADP numbers this morning, definitely a little disappointing on the labor side.
And I wonder whether these numbers are connected to the uncertainty over tariffs. And going back to what you were saying before about inflation, where we were a few weeks ago was people were terrified of the inflation that would come out of these really highly increased tariff rates. I don't think we're ever going to get to those rates that were threatened when we saw the famous board out in the White House. But it doesn't seem like we're going to see anything anytime soon either. So I would be surprised if there's any inflation due to tariffs for quite some time. Hence the reason why perhaps the Fed could cut the rates between now and whenever that happens.
That's a good point. I do think also, just like all of us watching for a statement from Japan, watching from the EU and the US for deals to get made, I'm sure very confidently that the Fed is wired in even more so than us on those conversations. Even though when this all got started, Johnny, remember that Powell kind of refused to comment on the fiscal plan or the policies, the tariff decisions. Now it's in his face because, of course, it's in his backyard, which is the inflation mandate, right? So now there's high attentiveness to what's happening with different trade partners and things like that. And I think that the Fed, as much as it is, they're going to get criticized by the president to not make a preemptive move. There's something that I've been thinking about that I'm curious what your thoughts are on this. Trump makes these kind of posts saying, hey, you need to cut the interest rates. But remember that Trump and team have more information than the rest of us. They are in these negotiations. They know what is happening behind closed doors with countries. And they're saying, you need to cut interest rates because they have a little bit more forward knowledge on some of the, that is of course why everything Trump and team posts causes such a market stir, is because the market's like, hey, they know something that the rest of us are not yet aware of, or they have some information based on private dealings and things like that. So yeah, I mean, in terms of the ADP numbers, is it a little bit of forward uncertainty? Maybe a little bit. We do still see many sentiment surveys showing some uncertainty in the markets, but to combat that, we did have CB consumer confidence, which came in really strong last week, which showed a little bit of a rising optimism, I suppose, in terms of all of this uncertainty that you mentioned. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.